Good morning from our global headquarters in New York City. I'm Danny Berger. Manish Cranny is off this week. Welcome to Bloomberg Brief. Let's set your agenda. A game of chicken. Senate Democratic leader Chuck Schumer says the party will reject Republicans' funding bill. On shaky ground, concerns over potential government shutdown drag futures lower after a volatile session. And Intel finally has a new CEO. The appointment of chips veteran Lip Bhutan lifts shares in the early trade. Well, we seem to be selling into the rallies instead of buying the dip. That's what we got this morning. A decline on your future session, down about 0.4%. The sound you heard yesterday was the market sighing of relief. CPI coming in cooler than expected. At one point, equities had rallied 1.3%. But again, we give that back. The IIAA survey coming in at a 2-year low yet again this morning. JP Morgan writing, though, that the worst of the correction might be over. Treasuries, those struggled yesterday. Notable that the yields ended higher, even though we had softer CPI. Looking through that, we are little changed this morning. Your 10-year yield basically flat at 4.3%. Your 2-year yield at 3.98. Now, some individual stocks to keep our eyes on this morning. I mentioned Intel. That is rising in the pre-market session. We learned yesterday about the appointment of chip veteran Lip Bhutan as its next CEO. Those shares up 10%. Adobe to the downside, giving a disappointing outlook. Shares are down 4.7%. That disappointing outlook was for revenue growth in the current quarter. It has been focusing on monetizing its new Gen AI features for products like Photoshop and Premiere. Finally, rounding things out with American Eagle, those shares are also lower this morning in the pre-market session, down 10.5%. It reported a weak forecast, said tariffs may dent its margins. That overshadowed its fourth quarter earnings beat. We got a great show for you this hour. We're going to be speaking with Toril Bosoni of the IEA, whose report has just been out. Concerned about their oil demand outlook, cutting that with the trade war ongoing. We'll also catch up with Marko Papic of BCA Research. Now, in Washington, D.C., Senate Republicans need 60 votes to pass their spending bill and avert a government shutdown this weekend. But Senate Democratic Minority Leader Chuck Schumer says that they, quote, do not have the votes, indicating that his party would block the bill. For the latest, we are joined by Bloomberg senior editor Bill Ferries. Bill, great to see you this morning. So it seems like we have a roadblock for the government funding bill.
Yeah, the clock is definitely ticking on keeping the government open ahead of that Saturday deadline. Democrats signaling they won't be a part of that 60 votes that's required to really get that legislation to final passage. There really is no plan B. The House is on recess now. It's unlikely you could get them back in 36 or 48 hours to come up with something different. But there's still time for the Senate Democrats and Senate Republicans to try to find some middle ground here, perhaps allow the Democrats to get votes on a few amendments to the legislation that they would like, and then allow the bigger continuing resolution to go through. That would fund the government through the end of September. Right now, what the Democrats are putting forward as a counterproposal is basically a 30-day extension into mid-April.
We know that one of the things that they did in this bill to try to help it pass some of the Democrats is not include DOGE cuts in it, because that would probably be unsavory for a lot of folks. Considering it doesn't include DOGE, just how much power does this government task force have going forward?
Well, it's an enormous amount of power, but what's adding to that influence is the fact that there's been so little pushback from Congress as a whole so far. So you see DOGE going after federal agencies, groups like the U.S. Agency for International Development and others, and those are all congressionally chartered groups, but Congress isn't pushing back. So that has really given Elon Musk and the DOGE team a lot of extra influence in this process. If the Republicans who run the legislature, run the Congress, aren't pushing back, the process will just kind of continue forward. Democrats would like to see more restraints on that. It's hard to know at this point, with just a couple days left, whether they'll really be able to use that influence to get changes in DOGE going forward.
By the way, on the front page of the FT, they're running with new Treasury data showing that U.S. federal spending rose to a record last month despite some of the job cuts. Bill, I just want to round things out with tariffs, because there was a lot of news flow over the past 48 hours. What do we understand some of the retaliatory tariffs are coming towards the U.S.?
Well, we know the EU is pushing back on this latest round of steel and aluminum tariffs. They're talking about targeting about 26 billion euros worth of U.S. imports. They've talked about going after soybeans from the American South. We know in the past they've gone off after very iconic products like Harley-Davidson motorcycles and Kentucky bourbon. That's all planned to come in if there is not some breakthrough within the next few weeks. In terms of the U.S. tariffs, the big thing looming at this point is April 2nd. That's when President Trump says reciprocal tariffs will come on every nation around the world that charges the U.S. Tariffs for its goods.
We do get some pushback in the form of markets, that have gone towards something that looked like a correction. Or even if you look at the IEA's latest report, Bill, they're saying that there are fears of oil demand slipping because of tariff threats. The tone from the White House, though, has been one of not necessarily caving into anything from the market. What is the message that the White House is trying to send, Bill?
Well, the main message I think we've heard from this White House is they're not looking at the daily gyrations in the stock market. They're not worried. We know in President Trump's first term, he paid very close attention to that. So the big question is is whether that pain point has yet to be reached, if there is one. The Trump administration saying they're pressing forward with these changes. It's important to transition the economy to depending less on government spending. But if the markets continue to see red going forward, it'll be interesting to see whether that remains the messaging we get from the White House.
Bill, we really appreciate your time. That is Bloomberg's Bill Ferries. And don't miss our upcoming interview with U.S. Commerce Secretary Howard Lutnick. The surveillance team will be catching up with the Commerce Secretary at 8 a.m. Eastern. Let's get you some other top stories now that are trending on the Bloomberg terminal. Deutsche Bank has increased its bonus pool to $2.7 billion. That is the largest amount in a decade. It's also a roughly 26% increase from last year. A surge in deals and trading last year helped drive results. Deutsche also said that the pool was affected by a new system, which allows for a larger number of staff to receive bonuses. Elsewhere in banking, sources say that HSBC is placing some investment bankers on short-term retention agreements as it winds down certain businesses in a broad overhaul. The plan also includes cutting many of the vice chair roles in various markets. It still remains unclear, though, how many are affected by this latest move. Elsewhere, SpaceX has delayed the launch of a new crew to the International Space Station to help bring 2 stranded astronauts home. NASA and SpaceX said the launch was stood down because of an issue with the ground equipment used to support the flight. It is now expected to take place no earlier than March 14th. Astronauts Butch Wilmore and Suni Williams have been at the space station since last June, so they will have to wait a while longer. Coming up, what impact are tariffs having on crude? We're going to have more with the latest IEA report and the concerns about demand. We'll be catching up with Toril Bosoni next. Don't miss that on your Bloomberg Brief. This is Bloomberg Brief. I'm Danny Berger in New York. The flurry of tariffs being unleashed in different announcements by the Trump administration is undermining the economic backdrop for oil demand. That's according to the International Energy Agency, who just put out their latest report. Let's dive deeper into that. I'm pleased to say that I am joined by Toril Bosoni, head of Oil Markets Division for the IEA. Toril, thank you so much for joining us this morning. So yes, you and the team write that macro conditions that underpin our oil demand projections deteriorated over the past month as trade tensions escalated. What is your estimation in just how harmful some of the tariffs, some of the trade war escalations will be for this oil market?
Good morning. So we're still trying to understand how everything will play out. But obviously, the market is very focused on how escalating trade tensions may impact global economic growth and by consequence also oil demand growth. But our forecast for now is still underpinned by a GDP forecast on consensus of around 3%. And that translates into growth growth of about 1 million barrels a day this year. We have downgraded our forecast slightly from last month as we're seeing the readings, delivery data in the OECD and also in emerging and developing countries coming in weaker than expectations already at the start of this year.
So you're already starting to have some impact, Toril, but I wonder, is the bigger risk at this moment tariffs themselves, or is it the headline uncertainty? Is that the thing that's damaging to demand? If we get clarity from the White House, do you expect that some of that demand might normalize and come back into the market?
What we're seeing is it's an unusual level of uncertainty, not just on the demand side and with tariffs and trade negotiations that are changing from day to day, but we're also seeing quite a lot of uncertainty on the supply side. We're seeing sanctions on Iran and Venezuela and Russia. We're seeing continued unrest in the Middle East. We're seeing compliance, OPEC Plus announcing to increase production from April, and the policy from the group beyond April is still to be determined by the group. So there's a lot of uncertainty in the market, obviously. Clarity is always a good thing, but it's a fast-moving market that we're watching very closely.
A few things to go through there, Toril. Let's start with OPEC Plus. As you say, they announced that they're going ahead with supply increases. We've seen member countries like Kazakhstan going even further than that. But I know the IEA is sticking with its cautious outlook, that cuts might remain, or some form of cuts might remain in place. Is the market too fragile for OPEC Plus to proceed with supply increases?
Well, of course, there's still a lot of uncertainty in the market, but our forecast shows that global oil supply, even without further increases from the OPEC Plus group, would exceed our expectations for demand growth this year. As I said just before, we expect oil demand growth of about 1 million barrels a day, but you're seeing growth from the Americas, Canada, Brazil, Guyana, Argentina, Canada adding about 1.2 million barrels a day of growth this year, which at the face of it more than covers the demand growth. So there's obviously a lot of tensions in the market. Non-OPEC supply growth 1.5 overall. Kazakhstan, as you said, producing at record highs at the moment as the Tengiz expansion project came online after many, many years of development and billions of dollars of investment. So the market looks well supplied at the moment, which is creating some challenges for further increases from the OPEC Plus group. And as the group, the alliance, announced themselves, they will continue to monitor the market month to month and increase as needed. So until those increases are confirmed, we will wait to put them into our baseline forecast.
Well, Toril, as you've seen the U.S. moving to restrict some of its fiscal policy and some of these tariff headwinds, you see other countries shifting to a more stimulative policy. Europe comes to mind with the amount of defense spending they're going to do. China continues to talk about more stimulus that they want to put into the market. Are you seeing any signs that some of these markets might be picking up the slack for weakened demand?
That's obviously a possibility. We have seen that Europe increasing spending, and not just on defense, but also in some of the industrial sectors. And that, if that translates into increased economic activity, it can also shift some of the oil demand growth. But it's still early days, so we wait to see how everything plays out. For now, we're not seeing that increase translating into increased oil demand, but obviously these developments do take some time to play out.
Well, over the past 4 years, we've had these really momentous shifts for the energy market and the way that trade is rerouted, starting with COVID, then the war in Ukraine. Toril, in this moment where we're having another trade imbalance, we're having Trump focus rather on that trade imbalance and issuing various tariffs, are we entering another era where energy trade is about to be rerouted, where the global energy trade at the end of this might look different than it is at this moment?
What the last 4 years have taught us is that to show that the oil market is very adaptable. It adapts to all the changes and policies. When we saw first with COVID and then in Russia, that the oil finds its way to market is obviously having impact on prices, but the oil tends to flow to customers. Of course, any of these policies or measures may lead to less optimal trade routes that increase cost, both for shipping and in terms of time to get the oil to the market, which also have an implications for energy security. But what we do find is that the oil tends to shift. So if there's tariffs on Canadian and Mexican oil, for instance, it might have impact on prices, but we also see that the suppliers find new customers, perhaps in other parts of the world, if possible.
To a really fascinating report this morning. Thanks for spending the time with us. That is Toril Bosoni of the IEA. A quick check on your commodity markets this morning. It has been very volatile for oil. At one point over the past week, we saw oil trading at a 3-year low. Then it gets the biggest surge yesterday in 2 weeks. Brent crude, little change this morning at just under $71 a barrel. NYMEX crude at $67.56. Coming up, the new face of Intel, chips veteran Lip Bhutan plans to bring the company back to its former glory days. Can he achieve it? We're going to discuss next on your Bloomberg Brief. Let's take a look at the front pages this morning and what's making headlines. First, the New York Times has this on their front page, that the EPA is targeting environmental regulations. That includes limits on pollution from tailpipes and smokestacks and protection for wetlands. The EPA administrator, Lee Zeldin, said that his agency's mission is to, quote, lower the cost of buying a car, heating a home, and running a business. Next up, we have this on the Bloomberg, that the UK and France are working to strengthen Ukraine's negotiating position as President Trump pushes to settle its war with Russia. European defense ministers are discussing ways to provide security guarantees for Ukraine, including a reassurance force with troops, aircraft, and naval vessels. The plan is present that to Trump, hoping to persuade him to commit to U.S. security guarantees. The Wall Street Journal leads with this on their front page, that Intel has named a new CEO. The announcement came yesterday that Lip Bhutan will be taking over. He's a semiconductor veteran and the former head of Cadence Design Systems, and he will assume the role on March 18th. For more on this story, let's get over to Bloomberg's Tom McKenzie, who leads our tech coverage. Tom, what is the task ahead of time?
It's a monumental task, isn't it, for Lip Bhutan, who is taking over, as you said, in March from Intel, given all the challenges of this business, given the challenge around trying to compete with NVIDIA, given the debt load, given the fact that they have seen their earnings plummet. For now, as you've seen, the market reaction pretty positive in the context, of course, of an Intel stock that is down about 50% in the last 12 months. But this is someone with deep experience at Intel, formerly a board member. He will rejoin the board, as well as taking on the CEO role, of course. Former head of Cadence as well, the software and design company, and will bring that experience to bear. He says this will be a challenging job, but he is committed. Every fiber in his being suggests and tells him he can turn Intel around. This is still a company that's turning around revenues of around $50 billion a year annually. It is still in about 70% of personal computers worldwide in terms of their chips, but the challenges are monumental. Also suggesting that the foundries business that they've spent so much capex on building out in the US, that will continue. Pat Gelsinger, big part of his plan, of course, before he was ousted, presumably for not doing enough to turn this company around. But this new CEO comes with the experience, comes with the ambition, but my goodness, the challenges for Intel are huge going forward.
Considering they're sticking with that foundry business, Tom, does it suggest that there isn't a big strategy pivot, or is it just too early to tell?
I think one factor to watch certainly is what's going to happen with the CHIPS Act. And you've seen President Trump suggesting and calling, in fact, for senators and for House Republicans to rip up the CHIPS Act. And Intel has been a key beneficiary of the funding that has come through from that. So that's one to watch. In terms of the clearer strategy from Lip Bhutan, it's early days. He sent out a memo. Bloomberg got access to that memo. But you're absolutely right. The next earnings call, that is where the scrutiny is going to be. To what extent are they going to shift the focus? What is the clear strategy? Are they going to spin off more parts of the business? We know that there have been some waiting in the wings to snap up parts of the Intel business. Is he going to have a cleaner focus on the core parts of this business? And what are they going to do in terms of those AI accelerators? What is the plan there in terms of the catch-up, given the gulf that exists now between Intel and its propositions on AI versus NVIDIA?
Tom, thank you so much. That is Bloomberg's Tom McKenzie. And as you can see there, shares of Intel are up in the pre-market trade. Just worth pointing out that we have gotten some upgrades for them. Bank of America upgrading their call on Intel on the new CEO. So there is some enthusiasm, as Tom mentions. We'll see what they say in terms of strategy on their earnings call. It's been a rough ride for tech, but we are seeing a rebound more generally. Okay, coming up on the show, the tech bros are lying to you. We're going to look at that sell-off in tech and what it means for the wider industry. We're going to be catching up with BCA's Marko Papic as policy uncertainty keeps tech investors on edge. He's going to be joining the show next, your Thursday morning, your Bloomberg Brief. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. A game of chicken. Senate Democratic leader Chuck Schumer says that the party will reject Republicans' funding bill. On shaky ground, concerns over a potential government shutdown drag futures lower after a volatile session. And Intel has a new CEO. The appointments of chips veteran Lip-Bu Tan lift shares in the early trade. And we seem to be selling into the rallies versus buying into the dip. We are moving lower this morning, down 0.4% for your NASDAQ 100 futures. Despite the rally in Intel this morning, that's not helping the overall equity indexes. Your S&P down 0.2% after a rally yesterday that was paired despite the excitement over a CPI that maybe took stagflation concerns off of the map for now. Your Treasury session also struggled yesterday, notable considering we had that cooler CPI. We're little changed this morning. 3.98 on your 2-year yield, 4.31 on your 10-year yield. The U.S. equity market, though, continues to flirt with a correction, and tech has been particularly hard hit within that. The NASDAQ, 12% below its peak. The Mag 7, 18% below its peak. BCA's Marko Papic writing, no sector has profited more from fiscal profligacy and subsequent multiple expansion than the U.S. domiciled big tech. The bottom line is that U.S. big tech are effectively railroads and that tech bros are universally lying about their moats. Marko, I'm pleased to say, joins us now. He's chief strategist of BCA Research. Marko, punchy. Very punchy. Yeah. Look, a lot of people would say the sell-off in tech is just because things got overvalued, things are coming back down to earth. Are you kind of pushing back against that idea, that it goes further and it's deeper than that?
Yes, I am. I'm basically saying that for the past 5 years, we've had a really extraordinary amount of fiscal profligacy. I mean, the deficits have expanded massively. The U.S., much more so than any other economy in the world, spent on fiscal 4 times more than Europe in particular, basically the same level of spending as World War II. And all that fiscal spending went into multiples, went into earnings, and has benefited U.S. domiciled big tech the most. And so if we now have a shift towards less profligacy, I think that there will have to be a re-rating of U.S. assets in general, not just big tech, the dollar, other equities as well. But of course, big tech has run out the most, so it will be impacted the most.
Is this short-term or long-term? And part of the reason I ask this is because this is an administration who's been saying that the pain is short-term, but in the long term, it's a shift towards the private sector, that the private sector picks up where government spending ended. So can tech get back to where we were, just the end of that fiscal surplus, of the fiscal giving it to various tech companies or finding its way into tech companies earning, that ending is enough to completely re-rate tech?
I think it's really, really significant. And what you see over the last 6 weeks, the trading over the last 6 weeks, doesn't really make sense from the context of what we're focusing on. Tariffs, trade. Why is the dollar down as much as it is against the euro? Euro was supposed to be at parity. It's at 109. Why are European equities leading over the U.S.? I think that's sending you a long-term signal that the market doesn't really care that much about trade and tariffs. It cares much more about fiscal matters, U.S. versus Europe. And so I do think this shift is permanent. It doesn't mean that tech has to re-rate and collapse as it did in 2001. You know, NASDAQ was down 80% in 2001 recession. That doesn't have to happen. The issue is that outperformance of non-U.S. assets, I think, is permanent.
Does that mean that the leadership in the U.S. in things like AI, that's also challenged at this point?
So that's a different part of my argument. It's not really about fiscal matters. It's more, I do think DeepSeek really mattered. And I think it matters because effectively what the DeepSeek phenomenon tells us is that you can have innovation in the AI space outside of big tech. I think that's fundamentally. Big tech will continue to provide the infrastructure. It will continue to have cash flow and earnings because it's building the rails upon which the AI revolution will run. But it will not have a monopoly over the productization of AI or innovation. And so, yes, other sectors could actually benefit more: healthcare, financials, industrials. And that calls for two things: rotation out of big tech inside the US, but also because other equity markets are less leveraged to tech, also from a global asset allocation, rotation out of the US in general.
I say that there's something ironic about this in the fact that you had all those tech CEOs lining up behind President Trump at the inauguration, and this is the outcome that you're speaking of. But I wonder if them also getting more political, let's call it that, is also an issue for them, where you have China targeting different tech companies in the U.S., pulling back on approving Tesla's self-driving capabilities. Europe, basically their strongest suit is their ability to regulate in the single market. Is tech's turn political now a big weakness for them, especially as a trade war heats up?
You know, I didn't think of it that way, Danny, but I think it's certainly one of those things that maybe marks the top, if you will. And we do have the old adage, buy the rumors, sell the news. And I think one other way you can look at it is, you know, you have an America First president, but you may have America Last performance in relative terms in equity indices. And I think that's what the last 6 weeks have told us.
Well, one thing that a lot of people point to is that it's the uncertainty, the thing that's causing the sell-off. You've had Trump having his business roundtable meeting with leaders. One of those people was David Solomon at Goldman Sachs. He did speak to Fox yesterday, and I just want to quickly play some of the sound of what he said.
The more we can have certainty on the policy agenda as we move forward, the better that's going to support capital investment and growth.
So before he said that, Marko, he also said he wasn't opposed to the tariffs. It could be a good policy. He just wants certainty. Is certainty enough, or is it the policy itself that's a problem?
I think that certainty is enough, so far as the policy is not too extreme. And I think that too many people, especially here, you know, I've been meeting with a lot of investors in New York over the last couple of days. Everyone's asking the same question: what is President Trump's preference? I think the answer is nobody knows. I think he himself doesn't yet know. I think he's feeling his way through material constraints. And as he does that, there'll be uncertainty. And once the market, once the economy shows him the limits of his preferences, that's when things are going to get better.
Can you just talk about what would that look like? The economy showing the limits.
I think recession probability going up is obviously one of the limits. I don't buy the view that, you know, President Trump is unconstrained by recession, that he's in his second term, that he can't get reelected. I think that the reality is political capital is a very strange concept. It's a qualitative, mushy concept, but we can measure it. Approval rating, congressional approval rating for Republicans, upcoming midterm elections, all sorts of things can matter. And a lot of allies might start jumping ship if that political capital starts being drained, however you measure it. And so I do think that approval rating, recession risks, equity market drawdowns all still matter to any policymaker, and President Trump is no different on that front.
So just be clear, there is a sort of but it just looks a lot deeper and a lot more severe than where we are at this current level.
I think so. I think it is deeper than the current level. But the other thing that I would also point out, I mean, Solomon is talking about uncertainty.
Right.
Uncertainty is far greater to non-U.S. markets. U.S. is an insulated, domestically oriented, you know, consumption is 70% of GDP. Exports are very, very single digit. So my, again, challenge to the investment community is take a look at market action. Trade war was supposed to be very positive for the U.S. dollar. It was clearly not supposed to be negative for big tech, which should be insulated from it. And yet, here we are. And I think that we shouldn't ignore market signals. Market is telling us that there's a very deep rotation going on outside of the U.S., and I think it's sustainable on a 5-year trajectory.
Marko, this has been so fascinating. We could do this all day. Unfortunately, I'm out of time, though. Marko, so great to see you. Thank you for coming in this morning. That is Marko Papic of BCA Research, and you are watching Bloomberg Brief.
Funding the government should be a bipartisan effort, but Republicans chose a partisan path, drafting their continuing resolution without any input from congressional Democrats. Because of that, Republicans do not have the votes in the Senate to invoke cloture on the House CR.
Senate Democrat leader Chuck Schumer saying that his party plans to block the Senate Republican spending bill, leaving the door open to a government shutdown this weekend. For more, we're joined by Bloomberg government reporter Kate Ackley in Washington. Kate, how likely does a shutdown seem at this point?
Well, it's more likely than it was 24 hours ago. We saw the rhetoric kind of shift over the day yesterday with Senator Schumer's comments that you just played, and we have another pivotal day teed up on Capitol Hill today and in Washington. They may come to a deal. They've still got a couple of days, but it's, keep in mind that the House voted on this measure earlier this week and then left town. So the House of Representatives is not in session right now, and they would have to come back if there was going to be a different bill that passes Congress. How do we understand the Democratic strategy here, Kate? Because the larger political narrative has been this one of uncertainty, concerns about a recession starting to bubble up. Yet they're kind of taking attention away by making moves that get us closer to a government shutdown. So what has been the word for Democrats and why they would pursue this strategy? Well, there are several things going on, obviously, all at once. I think you're seeing Democrats test out their messaging strategy. They are still working out their own strategy, Senate Democrats. Keep in mind that they're hearing from a sort of broad range of constituencies. And if you want to take a look at the local level, D.C., this stopgap measure that passed the House this week would essentially tie up $1.1 billion of local D.C. budget funding. And so we've seen D.C. Mayor Muriel Bowser, members of the D.C. Council, go up to Capitol Hill this week and say, this stopgap measure that passed the House is really bad news for the D.C., the local D.C. budget, the police, the schools, and the city services. And, I'm a D.C. resident, so I have seen a bit of a groundswell over the last 24, 48 hours of people urging their friends and family who have senators across the country to put the pressure on their senators to change this, fix this, pass a different measure that would not limit DC's spending authority for the local resources. And D.C. already under pressure with the cuts being made to DOGE. It feels like a vibe shift that's really undergoing there. But Kate, I thought this was interesting. The FT has a story this morning looking at Treasury data saying that U.S. federal spending has risen to a record $603 billion that month, and that there was only a handful of departments that registered drops in spending on any form. How have we seen the impact of DOGE thus far, and what's to come, Kate? Because at the moment, the data itself on a headline basis doesn't show too large of an impact. Well, we have a few things to keep in mind. Number one, the uncertainty. So you have a lot of federal workers who maybe are still employed, who've got their resumes ready, and they're sending them out, and they're looking for jobs, not just in the Washington, D.C. region, but across the country, people looking to make big life moves. So stay tuned on that. And the other thing, we have a couple of deadlines coming up where, yes, we've seen the DOGE cuts, which I think people have sort of likened to more of a sledgehammer approach, if you will, and some of those have been peeled back. But now you have agencies under a deadline. One is today, phase one, to kind of list their reductions in force, who they're going to let go. And then a month from now, there's another deadline. So you see sort of these staggered deadlines where agencies and federal departments themselves are going to be recommending, here's who we think should be cut. So you have a number of federal employees potentially on the chopping block over the coming months. And just to point out to our audience, we will be getting initial jobless claims in under 3 hours' time. So we'll see if any of the beginnings of that have started to appear. Kate, thank you so much. Bloomberg Government's Kate Ackley. And don't miss our upcoming interview. The surveillance team will be speaking with U.S. Commerce Secretary Howard Lutnick at 8 a.m. Eastern.
Let's turn now to banks. Deutsche Bank this morning announced that it's boosting its bonus pool to a decade high. That's after the lender saw a surge in deals and trading last year. For more, we're joined by Bloomberg's managing editor for EMEA Finance, Jenny Surain. Jenny, it's remarkable the difference in fortunes between Deutsche Bank and some of the American banks. Deutsche Bank up some 30% this year. The likes of JP Morgan have moved lower by 4%. What accounts for the change in fortune for the likes of Deutsche Bank?
I think there's a couple of things going on at Deutsche Bank. So, they're really known as like a fixed income powerhouse, a debt capital markets powerhouse. Those are products that did really well, even throughout kind of all of the craziness of the U.S. election, the changing in central bank stances last year. So those are two products that did really well. And then I do think just more broadly, a lot of these banks are having to think about, ahead of another term with Trump, where his last term obviously brought lots of deal-making activity, lots of opportunities to kind of soak up trading activity. They want to make sure that their desks are properly staffed and that they've, paid them enough to keep them around for another year so that they can kind of benefit from all of the activity that Trump is supposed to bring. So I think you had a good year last year, just where they were positioned and what they're known for. But really, this is also a sign for kind of what they're expecting next year and what they want to be prepared for.
So take that macro context and put it into the micro of HSBC, because they have been going under this restructuring. A Bloomberg scoop this morning that some investment bankers are being put on short-term retention agreements. What kind of overhaul are they targeting, Jenny?
Yeah, so on the other side of the fence, you're absolutely right. We have HSBC, which has been doing a broad restructuring. So it's not just within their investment bank, but within their investment bank, they did decide, we've always been known as, again, a debt capital markets powerhouse and really better on the debt side. We haven't been able to get the traction that we wanted on equities or M&A, and so they decided that they're going to get out of those businesses in a lot of key markets around the world. And so now you kind of see them sort of in the nuts and bolts part of that process. And so, telling these bankers that are working on deals that they had already signed up before making this decision, we're going to need to put you on these short-term contracts, and sort of working out exactly how their workforce is going to be phased out on these different projects. And so it's sort of in the same vein as Deutsche Bank. You see these banks, picking their spots, knowing where they're good, and in HSBC's case saying, what, we've got to call it quits when we know it's time to go.
Jenny, we appreciate the update. That's Bloomberg's Jenny Surain. Now, from banks to tech, shares of Intel, let's get a check on how those are faring in the pre-market session, because they've been getting a boost, up nearly 10%. They announced that they've appointed chip veteran Lip-Bu Tan as its new CEO to restore its position, they hope, in the semiconductor industry. Joining us is Bloomberg's Tom McKenzie. Tom, what do we know about Tan?
Yeah, look, he's a 65-year-old with deep experience in terms of engineering around semiconductors. Also someone with a track record, Danny. I think this is important as a turnaround winner. He managed to do that with Cadence in terms of the software company there. He turned that business around, so that is in his favor as well. We've had analysts talking to Bloomberg News saying that they welcome this, hence the kind of upside you're seeing, at least for now, in this stock. But my goodness, this is a resuscitation attempt of a corporate amongst the most challenging that we're thinking about as you look across the US right now with Intel and its debt load and its challenge around not being able to produce an AI accelerated chip to catch up with NVIDIA. The foundries part of the business, the fact that they're spending billions of dollars building that out whilst notching up billions of dollars of losses when it comes to earnings. So it is a turnaround that is needed. He says he wants to rewire and remake Intel for the future. Lots of question marks still remain, of course, but for now at least, a little bit of relief on the surface. Pat Gelsinger, of course, was forced out. The board didn't think he'd done a good enough job in terms of turning us around. Lip-Bu Tan comes in, former board member of Intel. He will retake a board seat as well as company CEO, and we'll be watching for the details and the commentary, of course, at the earnings when it comes through. He's taking his seat in March.
I was going to say, Tom, in terms of the timeline, how much patience will Tan get, given that the board did push out Gelsinger, given that some of the customers are maybe unhappy or confused or looking for some change when it comes to Intel and their own direction? Do we have a sense of when and how Tan will be laying out the future strategy of Intel?
The key question will be whether or not he will pursue the foundries part of the business, given the capex around that, whether that is the foundries in Israel, in Ireland, in Arizona, in Ohio. They benefited from some of the CHIPS Act funding, about $8 billion US. It is a hugely capex-intensive business. They want to be in a position, and this was part of the Pat Gelsinger strategy, to be able not just to manufacture their own chips, but to manufacture chips for their customers, to take on the likes of TSMC, a company, by the way, that is investing $100 billion US in the US alone. So that remains a key question as yet unresolved. Lip-Bu Tan has suggested in his memo that he wants to keep that strategy. The patience could wear thin. This is still a business that's churning over revenues of about $50 billion US a year. It is still providing chips to about 70% of PCs, but that is a market that is soft, flat, bottoming out. They want to be in AI accelerators, and they haven't managed to do that as well. So on those key questions, the foundries and what will they do in terms of AI accelerators seem to be two key questions that will be put to Tan. And the question marks, of course, over how much time he's going to have to turn things around. It's a juggernaut, and it's going to take time.
Tom, I want to wrap things up with a different tech story, and that is a Bloomberg scoop that the FTC will be moving ahead of an antitrust probe of Microsoft that the Biden administration put on in their waning days. There had been some hope that this would be an FTC that wouldn't pursue as aggressive antitrust policies as Biden. What signals do we gather from this?
Yeah, and that's the key point, isn't it? This is a key takeaway because the probe continues. It is a sprawling probe. Satya Nadella may have been there alongside other tech veterans and tech CEOs, of course, alongside President Trump. The expectation that with tech in the room with the president, that they might get an easier call and an easier set of officials in terms of the scrutiny and probing that they are facing. The signal from this suggests that isn't necessarily going to happen, that big tech and monopolistic behavior, alleged monopolistic behavior, is still a concern for these newly in place regulators at the FTC. They've already, what we know from Bloomberg reporting is they've been talking to customers, they've been talking to those parts of the ecosystem within Microsoft. They have to hand over, Microsoft has to hand over reams of data about its AI business, about data centers, about its relationship with OpenAI. This probe, these investigations can take years. They may not result in a case, but clearly it reminds us that scrutiny continues on big tech.
Tom, thank you so much. One of the best. We appreciate it. As always, Bloomberg's Tom McKenzie there. Coming up on the show, there's a deadline approaching for federal layoffs and restructuring plans. We also have another round of jobless claims. We're going to set up your trading day up next. This is Bloomberg. Get you set up for your trading day on this Thursday. U.S. PPI and jobless claims come out at 8:30 a.m. Eastern. Retail earnings will get Dollar General before the bell, Ulta Beauty after the market close. Plus, federal agencies have until today to submit plans to the Trump administration for large-scale layoffs. Let's quickly move through some stocks on the move. Adobe extending post-earnings losses. They gave a tepid outlook. American Eagle also to the downside, nearly 10% decline. They gave a weak forecast, also pointing out Wells Fargo just up 0.5%, but we did get an upgrade from RBC, citing an attractive entry point. That is it for Bloomberg Brief. Surveillance will take things from here with an interview with the Commerce Secretary in about 2 hours' time.